What if your car payment is silently stealing thousands every year, and the dealership actually wants you to stay confused about smarter financing options available today? Most people walk into dealerships focusing on monthly payments, not realizing that small tweaks in loan terms can cost or save them serious money over time. The #1 mistake Americans make is thinking a lower monthly payment automatically means a better deal, when in reality, it often hides higher total interest costs. Dealers are trained to stretch loan durations, add extras, and keep your attention on affordability today instead of the true price you'll pay over years ahead. And here's the painful truth. Many buyers end up paying thousands more than necessary, locking themselves into financial stress because they didn't understand smarter financing strategies. But what if there was a way to finance your car that actually works in your favor, cutting interest and giving you more control immediately today? There's a strategy financially savvy Americans use that dealerships rarely explain, because it reduces their profits while putting more money back into your pocket long term. And once you see how it works, you'll realize why many people unknowingly overpay, and how easy it is to flip the advantage in your favor. By the end of this video, you'll understand how to structure your car loan, what traps to avoid, and how to potentially save thousands over time. We're breaking down strategies used by smart buyers, from loan terms to interest hacks, so you can walk into any dealership confident and fully in control. First, you need to understand how lenders actually make money on your loan, because that's where the hidden costs and opportunities both live in plain sight. Interest isn't just a number, it's the engine driving your total cost, and even a small percentage difference can dramatically change what you pay over time. According to the Federal Reserve, average auto loan rates fluctuate, but many borrowers accept higher rates simply because they don't shop around or negotiate effectively beforehand. And here's where it gets interesting. Lenders price loans based on your credit score, loan length, and risk profile, which means changes can unlock better rates. Quick pause. If this is already changing how you think about money, hit subscribe, because we break down smart strategies like this every single week here. Now let's talk loan terms, because stretching a loan from 60 months to 84 months might lower payments, but it increases total interest paid significantly. Longer terms feel easier monthly, but you're paying interest for more time, which means the car costs far more than its actual value by event.
Smart buyers choose shorter terms they can comfortably afford, because reducing the loan duration cuts total interest and helps them build equity faster in their vehicle.
But there's another layer most people miss, and it has to do with how you structure your down payment versus keeping cash for other financial opportunities. Putting a large down payment feels smart, but what if that money could earn more elsewhere, changing your financial picture in ways most buyers never consider? Here's the smarter angle. Instead of dumping all your cash into a down payment, you compare potential investment returns versus loan interest to maximize your overall financial position. For example, if your loan rate is 5%, but your investments historically return 7 to 10%, keeping some cash invested could actually put you ahead. Of course, this depends on risk tolerance and market conditions. But understanding this trade-off is what separates average buyers from financially strategic ones in today's economy. Another overlooked strategy is getting pre-approved financing before stepping into a dealership, which instantly gives you negotiating power and prevents dealers from inflating loan rates. So what actually happens when you rely on dealership financing without comparing options, and how much extra money are you potentially giving away without realizing it? Dealerships often mark up interest rates above what lenders approve, keeping the difference as profit, which means you're paying more simply because you didn't secure your own loan. Banks, credit unions, and online lenders frequently offer better rates, especially if you have a strong credit score, making pre-approval one of the easiest financial wins available. Even a 1% lower interest rate can save you hundreds or thousands over the life of a loan, which is why this step is a total game changer. And here's something most people never think about. Your loan isn't locked forever, meaning refinancing later could reduce your rate and lower your total cost significantly. Still with me? Good, because this next strategy is where many Americans lose thousands without even noticing, and fixing it could instantly improve your financial situation. Let's talk about add-ons, those extras like extended warranties, gap insurance, and service packages that dealerships bundle into your loan, quietly increasing your total financed amount. Individually,
These costs may seem small monthly, but when financed over years, they grow significantly, adding interest on top of already inflated pricing structures.
Smart buyers separate these decisions from the loan itself, choosing only what they truly need and often purchasing protections cheaper through third-party providers outside dealerships.
Gap insurance, for example, can be useful if your loan exceeds the car's value, but dealerships frequently charge more than insurance companies for identical coverage.
Here's a surprising stat. Many buyers roll thousands in extras into loans without realizing they're also paying interest on those add-ons for years after purchase. Another smart move is making bi-weekly payments instead of monthly ones, which effectively results in an extra payment each year, reducing your loan balance faster. This simple shift can shorten your loan term and cut down interest without requiring a massive lifestyle change, making it one of the easiest optimization strategies available.
You can also round up your payments slightly each month, which directly reduces principal faster, meaning less interest accrues over time on your remaining balance.
These small adjustments might seem minor, but combined, they can shave months or even years off your loan, saving you a surprising amount of money. But there's one powerful financing strategy that flips everything most people believe about car loans, and almost nobody talks about it inside dealerships today. That strategy is leveraging 0% APR offers, but only when used correctly, because these deals can either save you thousands or quietly cost.
Automakers sometimes offer 0% financing to move inventory, which means you're essentially borrowing money without paying interest, something that can be incredibly powerful financially.
But here's the catch. These offers often replace cash rebates, meaning you must compare whether taking 0% financing or a discount actually saves you more overall. Sometimes, taking a rebate and using a low-interest loan beats 0% financing, especially if the discount significantly lowers the total price of the vehicle. Here's where smart math wins. A small calculation upfront can mean the difference between saving thousands or unknowingly choosing the more expensive financing path over time. And this is exactly why dealerships don't emphasize these comparisons, because an uninformed buyer is far more likely to choose the option that benefits the dealer. Another powerful move is understanding depreciation, because cars lose value quickly, and financing decisions should always consider how much the vehicle will be worth later. New cars can lose up to 20% of their value in the first year, which means your loan balance could exceed the car's worth early on. That's called being underwater on your loan. And it's a risky position because selling or totaling the car could leave you owing money even after it's gone. So how do smart buyers avoid getting trapped in negative equity while still driving the car they want without overpaying or taking unnecessary financial risks? One strategy is buying slightly used instead of brand new, letting the first owner absorb the biggest depreciation hit while you get a lower price. Certified pre-owned vehicles often offer warranties and reliability similar to new cars, making them a strong middle ground between cost savings and peace of mind. Financing a used car at a slightly higher rate can still be cheaper overall, because the lower purchase price reduces the total amount you're paying interest on. Another smart tactic is making extra principal payments whenever possible, because this directly reduces your balance and lowers the total interest you'll pay over time. Quick reality check, even an extra $50 a month can shave significant time off your loan, proving small consistent actions create big financial results. You should also watch out for prepayment penalties, because some loans charge fees for paying early, which can cancel out the benefits of aggressive repayment strategies. Always read the fine print before signing anything, because understanding these details gives you control and prevents costly surprises that most buyers only discover too late. And here's something powerful. Your credit score alone can dramatically impact your loan terms, making it one of the most important factors in car financing decisions. Improving your score even slightly before applying can unlock better interest rates, saving you money instantly without changing anything about the car you choose. Still with me, because next we're breaking down a strategy that combines timing, negotiation, and financing into one move that can completely change your deal outcome. Timing your purchase strategically can significantly impact your deal, because dealerships have monthly and yearly sales targets that push them to offer better pricing under pressure. Shopping at the end of the month, quarter, or year increases your chances of negotiating better terms, since sales teams are more motivated to close deals quickly. Holiday sales events can also create opportunities, but don't assume every deal is great, because some promotions are designed to look attractive without real savings. Smart buyers compare multiple dealerships, even within the same brand, because pricing and financing offers can vary more than most people expect across locations. Here's a surprising truth. The exact same car can have different prices at different dealerships, meaning comparison shopping alone can instantly save you serious money. Negotiation isn't about being aggressive. It's about being informed, confident, and willing to walk away if the deal doesn't align with your financial strategy. Walking away is powerful because it shifts control back to you, often leading dealerships to follow up with better offers once they realize you're serious. Another key move is negotiating the car price separately from financing, because combining them allows dealers to adjust numbers in ways that hide true costs. When you focus only on total price first, you create clarity, making it easier to evaluate financing options afterward without confusion or hidden adjustments. But there's a psychological trick dealerships use during negotiations that quietly pushes buyers into worse deals, and once you see it, you'll never fall for it again. It's called payment anchoring, where the dealer focuses your attention on a monthly number early, shaping your expectations before you've even discussed total price. Once that number is set in your mind, everything else feels relative, making it easier for them to adjust loan terms or pricing without you noticing the bigger picture. Breaking this tactic requires shifting your focus back to total cost, interest rate, and loan duration, keeping control of the conversation where it truly matters financially. You can even bring your own numbers into the negotiation, using pre-approved rates and calculated payments to challenge any offer that doesn't match your expectations. If you're learning something real here, smash that like button, because it helps more people discover these strategies and avoid costly mistakes with their money. Another overlooked move is checking your loan's total interest amount before signing, because that's the true cost beyond just the monthly payment you're agreeing to. Seeing that total number often changes how buyers think, revealing how much extra they're paying and motivating smarter decisions before committing to long-term financial obligation. And remember, everything is negotiable, from interest rates to fees, especially if you have strong credit or competing offers from other lenders already secured. Confidence combined with preparation creates leverage, turning what feels like a stressful process into a controlled financial decision that works in your favor long-term.
Still with me? Because next we're uncovering a hidden cost most Americans ignore completely, and it could be quietly draining your money every single month.
That hidden cost is insurance, because your financing choice directly affects your monthly premiums, and most buyers never factor this into the total car ownership cost. Lenders often require full coverage insurance on financed vehicles, which increases your monthly expenses compared to owning a car outright without loan requirements.
This means your real monthly cost isn't just the loan payment, it's the combined expense of financing, insurance, maintenance, and depreciation working together over time.
Smart buyers calculate total cost of ownership before purchasing, giving them a clearer picture of affordability instead of relying only on what the dealership presents. Here's a reality check. A cheaper car with higher insurance can cost more monthly than a slightly pricier car with lower insurance, completely flipping your expectations. Another overlooked factor is interest compounding, because auto loans typically use simple interest, but the longer the loan, the more total interest accumulates steadily. Shortening your loan term reduces this accumulation, meaning less of your payment goes toward interest and more goes toward owning your car outright faster. And here's something powerful. Aligning your car purchase with your broader financial goals ensures you're not sacrificing investments, savings, or retirement contributions like a 401k.
According to many financial experts, cars are depreciating assets, so minimizing how much interest you pay on them is one of the smartest financial decisions.
But what if there was a way to structure your financing so efficiently that your car actually supports your financial growth instead of holding you back?
This is where aligning loan payments with your income strategy comes in, ensuring your car expense stays within a sustainable percentage of your monthly earning. Many experts suggest keeping total car expenses under 15% of your income, helping you maintain flexibility while still enjoying reliable transportation without financial strain. Exceeding that range can limit your ability to invest, save, or handle emergencies, making your car more of a financial burden than a practical asset.
Another advanced strategy is refinancing after improving your credit score, which can lower your interest rate and reduce total loan costs without changing vehicles. Here's a powerful insight. Even a small rate drop through refinancing can translate into hundreds or thousands saved, simply by adjusting your loan at the right time. You should also monitor market interest rates, because refinancing during lower rate environments can give you an advantage many borrowers completely overlook in practice. And don't forget, your car choice itself impacts financing, because reliable models often qualify for better terms and cost less to maintain over time. Choosing practicality over impulse can significantly improve your long-term financial health, even if it doesn't feel as exciting in the moment of purchase. Every decision in the financing process connects, from credit score to loan term to negotiation strategy, forming a system that determines how much you truly pay. Still with me, because what comes next ties everything together into one simple framework that can completely transform how you approach car financing forever. Here's the framework smart buyers follow. Control the price, secure the financing, and optimize the repayment strategy so every step works together instead of against. Step 1 is negotiating the lowest possible purchase price first, ignoring monthly payments completely until you've locked in the actual value of the car. Step 2 is securing the best financing independently, using pre-approvals and rate comparisons to ensure you're not overpaying through dealership markup tactics. Step 3 is optimizing repayment through shorter terms, extra payments, or refinancing strategies that minimize interest and accelerate your path to full ownership. When you combine these 3 steps, something powerful happens. You shift from being a passive buyer to an active strategist controlling every financial variable involved. Most Americans only focus on one part of this process, which is why they leave money on the table without realizing how much control they actually have. But when you apply this full system, every decision reinforces the next, creating a compounding effect where small improvements lead to significantly better overall outcomes. And here's the real advantage. This approach doesn't require more money, it requires better decisions, making it accessible to almost anyone willing to learn. Whether you're buying your first car or upgrading later in life, these strategies remain relevant, helping you avoid common traps and build stronger financial habits. But there's one final mistake that quietly destroys all these benefits if you're not careful, and most people don't even realize they're making it. That mistake is buying more car than you can truly afford, stretching your finances thin just to meet a lifestyle expectation or emotional desire. Car marketing is designed to trigger emotion, making you focus on features and status instead of long-term financial impact, which can lead to costly decisions. Smart buyers separate emotion from logic, choosing vehicles that meet their needs while keeping their financial goals intact, instead of sacrificing future stability for present excitement.
Remember, your car should support your life, not control it, and financing decisions should always align with your broader plan for wealth building.
Here's the truth most people avoid. The difference between a smart car purchase and a bad one isn't income, it's awareness and decision-making discipline. Once you understand these principles, every dealership interaction becomes easier because you recognize tactics, avoid pressure, and stay focused on what actually matters financially.
This is a great deal. You should decide now.
I'll think about it. And over time, these habits extend beyond cars, influencing how you approach loans, investments, and major financial decisions across every area of your life.
Financial awareness compounds just like money, meaning the more you learn, the more opportunities you see, and the better decisions you make consistently.
So instead of rushing into your next purchase, take a step back, apply these strategies, and approach the process with clarity, confidence, and long-term thinking.
Know someone making this exact mistake right now. Share this video with them, because it could genuinely save them thousands and completely change their financial future.
At this point, you see the difference clearly. Car financing isn't just about getting approved. It's about designing a deal that actually protects your long-term financial future. Most people rush this process, but the smartest buyers slow down, analyze every number, and make decisions that align with their bigger financial goals. Because in the end, it's not about the car itself, it's about how that decision impacts your savings, investments, and overall financial freedom moving forward. Every dollar you save on interest is a dollar you can invest elsewhere, potentially compounding into something much bigger over time through smart financial planning. Here's a powerful shift. Instead of asking what car you can afford monthly, start asking how this purchase affects your net worth over the next 5 years. That single question changes everything, forcing you to think long-term and make decisions that prioritize financial growth instead of short-term comfort or emotional satisfaction. And once you adopt this mindset, you naturally avoid overpriced deals, high-interest loans, and unnecessary add-ons that quietly drain your finances over time. Instead, you focus on efficiency, control, and strategy, turning what used to be a confusing process into a clear system that consistently works in your favor. This is how financially smart Americans approach major purchases, not with emotion or pressure, but with clarity, preparation, and a plan that protects their future. But before you make your next move, there's one final insight that ties everything together and ensures you never fall into common financing traps again. That insight is simple but powerful. Always make decisions based on total cost, not monthly payments, because that's where the real financial truth always exists. Monthly payments can be manipulated easily, but total cost reveals everything, making it your most reliable tool when evaluating any financing offer or deal. When you focus on that number, you cut through the noise, avoid distractions, and make decisions that are grounded in logic rather than sales tactics or pressure. This single habit alone can save you thousands over your lifetime, not just on cars, but across every financial decision involving loans or financing structures. Think about it. Every time you choose total cost over monthly comfort, you're actively increasing your financial intelligence and protecting your future wealth potential. And that's the real goal here. Not just saving money once, but building habits that consistently put you ahead financially in every major decision you make. Because over time, these small, smart decisions compound, creating a massive difference between those who stay stuck financially and those who steadily build wealth. And now you have the knowledge most people never learn, giving you a clear advantage the next time you walk into a dealership or consider financing options. The difference now is awareness. And that awareness is what allows you to make smarter, calmer, and more strategic financial decisions without pressure or confusion. So the next time you're offered a deal, pause, analyze, and remember everything you've learned here, because that moment determines whether you win or lose financially.
And if you play it right, you won't just buy a car. You'll make a smart financial move that supports your future instead of holding you back.
That's the difference between average buyers and financially aware ones. And now you're equipped to be on the winning side every single time.
This isn't just about cars, it's about control, awareness, and building a mindset that protects your money and grows your financial confidence over time.
And the more you apply this thinking, the more you'll notice opportunities others miss, giving you a long-term advantage in a system designed to confuse buyers. So take this knowledge seriously, apply it step by step, and turn every future purchase into a strategic decision that builds your financial strength. Because at the end of the day, it's not about how much you earn, it's about how wisely you use what you have in every decision. And now, you're no longer guessing, you're making informed choices, and that's what separates financial stress from financial freedom over a long run. If this changed how you see money, subscribe, like, and share this video, because more people need to understand how to take control of their financial decisions. And if you're serious about leveling up your finances, check out the next video on your screen, where we break down another powerful money strategy.
Your financial future is built one decision at a time, so make the smart ones, stay informed, and we'll see you in the next video.